Hey, what's up everyone? Here in this channel, you'll find everything you need to know about investing, real estate, stocks and crypto, and how to get started investing from A to Z. In this video today, I will be sharing with you the stock market investing, inflation, and interest rates. If you're into that sort of content, please subscribe and hit the like button and the bell notification so you don't miss a video. So, a few months ago, the annual inflation rate has increased in the US and is now running at 7% per year. As a result of this inflation, Jerome Powell and the Federal Reserve are looking to raise interest rates 3 times this year. They are looking to slow the economy and put the brakes on business. But it's not a surprise that when interest rates rise, businesses and thus stock markets start to look less enticing, whereas super safe government bonds are more enticing. And that doesn't necessarily mean that stock market will go down, but a high interest rate environment certainly puts a lot pressure on the stock markets than a low interest rate environment. And this has been concerning investors. In recent years, they have seen great gains, but they are now worried that with rising interest rates, these gains might not continue. And in fact, we might even see the opposite. A doom and gloom narrative is really taking hold in the media, with inflation now over 7%, making everything seem even worse. On these news sites these days, it's hard to avoid a big negative headline that does not relate to inflation, interest rates, or the Fed. Yet, looking at all this talk and concern about inflation and interest rates reminds me of what Peter Lynch, author of One Up on Wall Street, said all the way back in 1994. He said that no one can predict the stock market. They try to predict interest rates. If anybody predict interest rates right 3 times in a row, they'd be a billionaire. There's not that many billionaires on the planet. I studied these when I was at Boston College. There can't be that many people that can predict interest rates because there'd be lots of billionaires and no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied old stuff. I didn't remember anyone telling me we were going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know the Dow Jones average a year from now would be X. Then we're gonna have a full-scale recession. Our interest rate is gonna be 12%. That's useful stuff. You never know it though. You just don't get to learn it. So I've always said if you spend 14 minutes a year in economics, you've wasted 12 minutes. And I really believe that. So that's what Peter Lynch said, and I keep that in mind all the time. Whenever I feel like I'm being sucked into market prediction, I just think of what he said because it really makes you realize that these market predictions and interest rate guesses that there are constant in the world of stock market. This is a lecture from 1994, and all of the talk back then was whether the stock market will crash and what interest rates will be. But did it matter? I mean, have you ever taken a finance or economics class where they referred back to what the interest rates were in 1994 and how much it influenced the long-term performance of the stock market? No, because it was totally inconsequential. You know, back then the S&P 500 was at 460 points, but today it's at 4,600 points. But it's funny that at the time that topic was being talked about as though it needed to be figured out or it could spell doom and gloom for investors, and today we still talk about it in the same exact fashion. So I hope you get the same feeling that I do after thinking about what Peter Lynch said. You know it didn't matter back then, so it probably doesn't matter now either, not if you're in the market for the long term. Peter Lynch also said Alan Greenspan, a very honest guy, he would tell you that he can't predict interest rates. He could tell you what short rates are going to do the next 6 months. Try and stick them on what the long-term rate will be 3 years from now. They'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if they had a Federal Reserve can't do it? So I think that you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years, a century. This is easy to do. The market's had 50 declines of 10% or more, so 50 declines in 93 years, about once every 2 years, the market falls 10%. We call that a correction. That means that a euphemism for losing a lot of money rapidly, we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25 or more. That's known as a bear market. We've had 15 declines in 93 years, so every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14, it goes to 6. That's great. You understand the company, you look at the balance sheet, they're doing fine, you're going to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines, they're going to happen. No one knows when they're going to happen. That's the key message for investors. For all the investors worrying about inflation and interest rates in a recession, just think about what Peter Lynch said. It would be nice to know where the S&P 500 is going in a year or what interest rates will be in 2 years, but nobody knows and no one knows that. Inflation and interest rates might spike to 15% and the stock market might tank 30%, but you will not know when or if that will happen. So as an investor, what you really need to do is, as Peter Lynch said, you need to accept that the market is going to go down sometimes. You know, market declines happen. No one predicted the pandemic. It hit the US and the market tanked 30% at the start of 2020. Tell me that series of events was going to occur in October 2019. Nobody knew that just a few months later, their portfolio was going to be worth 30% less. So as an investor, accept that such events will happen from time to time and accept that they may surprise you. If you're at peace with those two things, then you can start to get in a better frame of mind as to how to approach your investing. And spoiler alert, it's to always maintain a long-term mindset. Here's what Peter Lynch also said. Obviously, the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's been a lot higher in 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. When I ran Magellan, 13 years declined 10% or more 9 times the market. I had a perfect record. It went down more than 10% every time. Whenever the market went down, it went down more. But over the long term, the upside is more than the downside. So you're gonna say to yourself, do I need the money in the next month? Do I need money next year? Do I have kids going to college? I have a wedding coming up? Then you're a bad investor. If you can keep putting money in your 5, 10, 15, 20, 25 years, you should do well. So there you go. The market goes down, you won't see it coming, and it will sting you at some point along your investing journey. So with that in mind, what are you going to do? As Peter Lynch just said, if you're investing money that you need in the short term to make quick buck in the market, then you're a fool. It's not a good idea to invest money you're going to need to pay rent, tuition for your kids, or money for the forthcoming wedding. Because if the market goes down in the short term and we don't know when it will happen, then you're in trouble. But you can do very well if you invest money you don't need and keep adding to your portfolio periodically over 10, 20, or 30 years. So at the end of the day, in Peter Lynch's eyes, the answer to the question how you should be investing during high inflation, how should we be investing during times where interest rates might go up a lot, is we should approach it the same way we always approach investing. We need to approach it rationally and not speculatively. Know that bad stuff will happen sometimes. You know that you're gonna cop it at some point. And that may be at a time when inflation runs hot and interest rates are high, or it could happen tomorrow. But who cares? Stay rational, stay focused on the long term, and that's the easiest solution to knowing you're gonna do well investing in the market during these times. But it's all about your investing temperament. Don't get caught up in the news. Don't get caught up in the speculation. Don't be influenced by fear or hype. So, as per Peter Lynch, there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8, get reasonably close to 16, that's the only level of math you need to know. You don't need to know the area under the curve. Remember that quadratic equation in an integral calculus and the area under that curve? I mean, whoever cared what was under the damn curve? But you had to study this. You don't need this in the stock market. So all you have to know is it's always going to be scary. There's going to be always something to worry about, and you just have to forget all about it. Cut it all out. And own good companies. Our own turnarounds. Study them, and you'll do well. So, to summarize, it will always be risky, and there will always be something to worry about, but all you have to do is own good companies and adopt a long term outlook. And what happens with interest rates and inflation, as well as the market's short term performance, really doesn't mean as much. And I think it would be better if Peter Lynch provides factors of these great companies that help protect them in inflationary times. It would have been great to actually hear it from the horse's mouth, from Peter Lynch himself. But after analyzing other successful investors for the past couple years, I've learned that you should look for companies that are simple to understand, have competitive advantages, and hence pricing power, enabling them to raise their prices without suffering any negative impacts. And then you want to evaluate at the company's debt structure. For example, if interest payments take the majority of the company's revenue, you don't want that interest expense to skyrocket if interest rates rise. So evaluating at fixed rate versus variable rate debt is always a smart idea. But overall, that is a sample of Peter Lynch tips that should provide you with some understanding as how to invest in times of inflation and when interest rates and the Federal Reserve are making news headlines every other day. I hope you got something out of this video, and there are plenty more tips and tricks that we will cover in our channel, but we hope you enjoyed this video. If you did, be sure to like and subscribe. Thank you for watching, and we'll see you on the next one.